Just your sense on market performance today, yesterday and the day before. We'd seen a bit of a pullback, but we'd seen financials gaining tremendously yesterday.
Yes, I think it's mostly based on expectations of third quarter results. So we've seen financials performing really well. They've actually been driving most of the market.
All right, let's talk about your expertise, the bond markets. Attention has been on Housing Finance Company and their bond issue, 41% oversubscribed. Just tell us who the investors are. We're told most of them are locals. And what does it say about the corporate bond market?
It performed very well, beyond expectations actually. And it's a good thing that a lot of the investors were local investors. We saw a lot of fund managers coming in. And surprisingly, also quite a number of banks came in because although they don't participate that much in the corporate bond market, the returns on this 7-year tenor compared to the current government 7-year tenor paper are pretty good, actually.
Okay, now some of the investors have opted for a floating rate, that's 20% of them, 80% for a fixed rate. Why this discrepancy?
Because with the current low interest environment we're experiencing in the country, with a floor of about 5%, because if you, the floating rate is based on the 182 Treasury bill plus a margin of 3%. So if you look at that, currently our 182-day bill is at about 2.022 average. And at that's pretty low because that comes to about roughly about 5%, which is a very low interest rate for a 7-year tenor paper. But the fixed was offering a pretty good rate at 8.5% compared to the current government 7-year bond on the market, which is trading at about 5.1 to levels of 5.25%. So most people would rather go for the fixed rate bond.
All right, now tomorrow marks the launch of the 1-year Treasury bill. As you said to me earlier on, these are issued every 2 months. What are market expectations?
The market is expecting the T-bill to come in at between levels of 2.9% to around 3.5%. What we've seen over the last, let's say the last two to three Treasury bill issues, that is the 91-day, the 182-day, is that the rates on the short end seem to have stabilized. They had been climbing up somewhat over, let's say, about 4 or 5 weeks ago, but they seem to have stabilized somewhat and have remained at the same levels with, for example, the 182-day bill last week remaining at a cutoff of 2.199 and the average rate actually coming down. So with this 1-year T-bill, we don't expect it to rise up so much. We expect it to 3.5 at the most, actually.
All right, let's talk about general market sentiment and the performance of the bond markets. We've seen increased activity in the last 8 months, high liquidity from the banks and also the low interest rate regime that you've spoken about. But there are a few jitters though, Kenneth, about the secondary market. Why is that?
I think the primary market has been performing well. I mean, none of the CBK primary issue bonds have been undersubscribed. The corporate market is vibrant with more and more players wanting to come in and raise funds through the bond market. But the secondary market has been very jittery for the last 3 months, let's say from August, mostly because the rates had been declining rapidly for the last 18 months, actually. So what has happened is we hit a bottom and there was nowhere else to go but up. So what has happened is that the rates have moved up slightly, about 200 to 250 basis points. So that has made the market very jittery with no one wanting to be caught out. And secondary trading has really declined. But what we've seen, I think even this week, is the week began on a low note with about 800 million shillings traded. Yesterday there was about 1.7 billion, today 2.2 billion. We've seen people coming in to take up positions on papers that are being offered above market, off market, looking for bargains, because we have market players who are panicking and selling off even at losses, and there are those who are calm and are watching the market, and they expect the market to perform, secondary trading to perform well January going forward. So they're coming in, picking up papers that are being shown at off market rates, and so the market this week has actually been on an upward trend.
All right, now lots of expectations for the second half of the year, third quarter results and the impact on equities you mentioned earlier on. Scheduled debt deals for the second half of the year come to about 20 billion shillings. The first, as we're seeing, with housing finance. But are these realistic expectations?
20 billion, I think, would say is a bit on the higher side, considering we only have about 3 months left to the year. But we should expect 1 to 2 more bond deals this year. As I said, the corporate bond market is very vibrant. This does not translate, however, to the secondary market, where trading in corporate bonds is limited. But on the primary, I mean, there's so many companies clamoring to raise raise funds through the bond market. There's a bit of a bottleneck because the corporate bond market is highly regulated by the CMA before a company can issue a corporate bond. So that slows down the process somewhat. But we should expect 1 or 2 more bond issues this month. Not 20 billion, but I'd say more within maybe 10 to 12 billion. I mean, look at HF. They were looking to raise 5 billion shillings and, with this bond issue. Actually, it's a 10-year note in 3 tranches. They've raised 7 billion, so that means they'll only have to do 1 more tranche of about 3 billion shillings. And they may do it this year or push it forward to, or follow the calendar they had initially published, which the next tranche was supposed to be in 2012.
All right, let's talk about other issues that might affect the bond markets. There was talk last month of the central bank introducing a cut-off interest rates, even if the rates are higher, a cut-off interest rate. Are these plans still underway, and how's the industry responding?
The plans were not received well by the industry. In fact, they were shelved for the time being, because what the industry was actually in an uproar, because being forced to pick a paper, to be allotted a paper at a rate you're not bid at, actually defeats the whole purpose of a market and competition. So what happened is everyone disagreed with these plans and they were shelved. But what was implemented is that the central bank agreed to be more open in their results. So now with every bond issue, every treasury bill issue, we're getting cut-off rates, highest bids, lowest bids, the average. What had happened before, which had actually made the market lose confidence in the central bank, was they would issue a paper and only quote the average rate or the cut-off rate without any other information. And I mean, for an investor, all this is critical information so that they would know where to bid for their papers in coming primary issues, right, the market, basically the market float they should expect, and so on and so forth.